Welcome back to another edition of Commodities in Transition. Today, our topic is global energy demand, and joining me to discuss this critical component of the outlook is Justin Smirk. Justin, welcome.
Thank you very much, Elliot. Good to be here.
Nice to be back. Justin, just to start with, I mean, we think about sort of the evolving energy outlook. We often think about the transition to EVs instead of internal combustion engines. And we've seen from the Bloomberg data that between 2018 and 2022, there's been about a five-fold increase in sales for EVs. There's an expectation that they'll double again to 2026 and continue to grow at quite a rapid pace into the 2030s. Obviously, less internal combustion engines means less demand for oil, but often sort of thought about is what the implications are for fossil fuel demand for the grid as well. What do you think is likely to transpire there?
It's actually a very good question, and we should break it down into two quick components. One of just like highlighting what's going on in China and their young EV fleet and their desire to reduce their reliance on imported crude oil does mean they can rapidly grow the share of EVs that they've got and actually make a meaningful dent in their imports of crude oil. So it is in fact going to be having an impact on global demand for crude oil in that space. But you're right, the bigger implications is what is needed for the entire grid in terms of generating power. We do know that more than 60% of the power generation in China comes through from coal-fired generation. And currently China is also the biggest investor by a long way of further coal-fired generation, around 135 gigawatts of power they've been putting on. So you put it in that framework, and what you're actually talking about is to expand and grow the energy requirements that are required to power those EV fleets within China. It does mean that you're going to be seeing an increasing amount of coal-fired generation coming through in China, increasing their demand for coal imports and coal power overall. Doesn't necessarily mean they're going to be not reducing their carbon emissions. EVs, even when they're powered by around 60% of coal-fired generation, over the lifespan produce less carbon emissions than what you'd see from an ICE or an internal combustion vehicle. But nevertheless, the movement towards EVs within China does mean China's going to have been growing demand for fossil fuel to power their grid.
That's very interesting. I think it's one of the points that's not necessarily recognised is that when we think about the electrification of the economy, we need so much more power. So we don't. Not only do we need to see this incredible proliferation of renewable energy, but also then we need to continue on that commodity fuel, fossil fuel demand to actually maintain that capacity as well for the foreseeable future. I mean, when I think about China as well, like you see, they're probably more likely, even with their strong ability to actually create solar panels. 95% of the world's solar panels are coming from there. They still need to potentially use carbon capture and those kind of ways to mitigate their carbon emissions rather than thinking about shuttering that fossil fuel capacity entirely. Particularly, obviously, you mentioned there that China has been responsible for about half these EV sales. So it's quite a point there to really highlight the demand that flows through and the supply that comes from it in terms of power and the need there. We think then more broadly about Asia. I mean, a lot of other economies are growing very strongly. We've seen not only Western companies, but also Chinese companies and Korean companies look to expand their production footing into other parts of Asia, such as Indonesia. And these are economies that have very strong development prospects by themselves as well. What's their kind of demand likely to be going forward?
Well, you can see even in there, at the moment, there is this tension unfolding about how they can grow their economies as strong as they want to, and as strong as they need to in the development process, as well as meeting the sort of carbon emissions that are unfolding. So we already know that the second biggest investor in coal at the moment and coal-fired generation is India, investing about a quarter of what China is doing, but still a chunky 30 gigawatts. And you've also got what's going on in the third ranker, which is Indonesia, which is still looking significantly at investing in coal of around 15 gigawatts. Now, the reason this all matters is at the moment, developing Asia doesn't have a really strong pricing mechanism for carbon. So there still is this incentive to invest in the cheapest and most easiest form of energy they can get hold of at the moment, which is coal, which is very abundant in the region, as well as being very easy accessible. Now, we do know that the formation of international treaties is putting further pressure on the type of development in energy we need to see. And as well as the introduction, particularly in Europe and now discussion around the world, of carbon border adjustment mechanisms where imports will be seen to be priced appropriately for the amount of carbon they contain. This will see some adjustment occurring. And at the first instance, what we're seeing is a lot of movement towards using of LNG. LNG being a lower emissions, again being a reasonably accessible within the region, is the one that a lot of regions, we're seeing it like in Vietnam and Indonesia, where the investment is focusing on as well as into LNG for a source. Now, what we need to see to encourage this lower carbon investment is further carbon pricing in the region to actually make the encouragement investment away from coal to other sources. And even when we think about carbon capture and storage, as you mentioned, that becomes more imperative when you're thinking about a higher carbon price, because it's much more efficient to take less carbon out of the amount of energy you're producing from LNG than a large amount of carbon out of from coal-fired power plants. So if we do want to see this transmission process be accelerated, we do need to see further development of carbon pricing within the region. And while renewables are going to be significant source of energy demand within the region and supply, because you can see meaningful investment in the region, to get the kind of growth we're talking about, where that region is growing faster than the global average, means we are going to need alternatives. And really, if we don't want to see coal, it's going to be based on LNG. And that means there's still going to be China in the background demanding more coal, and developing Asia perhaps demanding more LNG, which means we are going to still have significant demand growth for these commodities, at least for the near term.
So we sort of talked about demand. There's a huge amount of increase in the demand there. What about supply? I mean, are we likely to see that kind of pushing higher of prices because of this demand? And given we've seen such a lack of investment in the sector, or potentially going to get more of a supply response coming from a higher price?
So there's always, you're very, very I'm always very hesitant to say that markets don't work and prices won't invoke a supply response. We did see some signs that the market had changed the way it behaved. A good example was if you look at the oil market, very liquid, very dynamic market that we've been seeing. We did see a recent energy price crisis as we went through the Ukraine period. And yet, during that period of time, even though the price of energy spiked, US crude oil production, which collapsed during the COVID crisis, still couldn't get back to its pre-COVID levels, as firms focused mostly around on return to investors' capital, return on capital, and also new restrictions around production of energy within the US. Now, since then, we've seen OPEC enter them, OPEC Plus, Russia and the Saudi Arabia, but introduced their own quotas and production cuts, which further boosted prices. And recently, they've extended those cuts, which have again helped push prices up through $9 a barrel. Just recently, too, we've been seeing that response from US producers when there's been a surge in production coming online. So quite clearly, there is a trigger point that spurs on local production. And we're seeing it with coal mines around the world, too. While it's difficult to get investment off the ground, we are seeing this price spike being responsible for firms that are in the business now trying to maximise production. Now, that does mean there's price points and we do get the normal market operating. But what we're not seeing is the long-term investment, particularly in coal and LNG, and even for our own oil production. Western firms, Western investors are hesitant on making large-scale, multi-year investment in carbon-based energy for the fear that during this transition process, they'll be left with a stranded asset. So while we can say, yes, we'll get price responses, we'll get production responses, you won't see new coal mines going in any major way through Australia, and we're a major supplier to the seaborne trade. We're still struggling to see major investment into new LNG platforms and programs, which are multi-year, large-scale investments to get the production going. And in the US, which has got perhaps the most dynamic oil market, which are a lot of smaller firms which are able to come in and out and produce the energy, again, we're not seeing that same sort of kick in response to the prices we're getting. So the tension here is going to be one that's quite real, at least for the short run, in an environment where we've got growing demand for energy resources and a limited amount of capacity to meet it with carbon-based energy. Carbon-based energy prices are set to rise. And this shouldn't be seen as necessarily being a bad. We don't have a global carbon price. We don't have global agreements that we can set a price on carbon to help the adjustment processes. But because firms are unwilling to invest, we're now seeing a sort of a pseudo-carbon price come in, one where you get higher energy prices that would have been associated with a carbon price, helping to incentivize the move away from carbon-based energy. So the structure we're creating now may seem one that's sort of inflationary, but it is one that's necessary to encourage the investment in renewables rather than carbon-based energy.
So, I mean, higher prices as a commodity exporter, particularly with LNG, coal, that's a good thing for Australia in terms of thinking about the receipts that the government might get from this as well, the support from the national income. But what does it mean for Australian households, Australian businesses in terms of their energy costs?
Well, Also, we're an open market and we do export most of our energy sources, which means that our local domestic prices are very much tied to global prices. Now, we have seen during the Ukraine period where you get the spike in global energy prices, that did flow through to our domestic prices very quickly and very rapidly. And if we get these ongoing price rises again, you will be seeing pressure on domestic energy prices from these global oil prices. Oil prices, very transparent, we see it in our petrol prices, but because of our big export market for gas, we're now seeing it through our domestic gas prices as well. Now, the government did respond during the Ukraine crisis and put a cap on domestic gas around $12 a gigajoule. This is very important and it has helped lower Australian gas prices back to around those levels. But you will see over time, if we are seeing these ongoing tensions of rising demand for energy globally, particularly out of the emerging markets, at the same time we're seeing restricted supply of carbon-based energy, that will mean those prices will rise. And that will mean we will be seeing this tension domestically. How will we balance this price cap against rising global prices, against the need to control domestic inflation, as well as meeting the needs for demand on global energy?
Sounds like this is going to be in need of a number of more discussions about this. It's quite a complicated topic and a lot to unpack there. So I look forward to coming back and thinking a bit more about that in a future episode.
Thanks very much, Elliot. I'll look forward to that myself.
That's good. And just to all our viewers out there, continue to encourage you to continue to keep an eye on Westpac IQ. That's where we'll see all of our content around the global green transition and the global economy. We'll see you next time.